Okay, last chapter, chapter 25, capital budgeting and managerial decisions. This is about making large acquisitions and how do you finance that and how do you plan for that. An alternative is also maybe which ones to sell. And with capital budgeting, typically the outcome is uncertain because you're dealing over usually a project that has an extended period of time. Large amounts of money are usually involved. Case in point, you're buying a major piece of equipment, maybe real estate, or joint ventures and so forth. And the decision may be difficult or impossible to reverse. Once you commit, these capital outlays, it's not something you can get out of because of the contractual issues. So, and again, it's because the investment is over a long period of time. So how do you evaluate these kind of investment possibilities? And there's a few methodologies that is used in the industry. And the first one, and the simplest one, that's not the most accurate, but it is the simplest, is called the payback period. And the payback period is the time expected that you're going to recover your initial investment. So let's give an example. You buy a truck for delivery for $10,000. How long is it going to take you to get that $10,000 back? And this is used a lot of times by small businesses because it's quick. They can do it in their head, off their hip. It doesn't take a lot of deep calculations. And the one that pays back the fastest is the favorable. This is inaccurate because, let me see if they talk about it. So, because it doesn't look at the total life of the project, it doesn't look at the total cash flow analysis, but it is simple. Because it's simple, it's used, like I said, a lot of times by smaller businesses who don't have more sophisticated techniques and so forth. And so, again, they're just taking, if you're going to, an example here, if your project costs $16,000, you're going to get $4,100 a year. You just simply divide that out, and it's a little under 4 years. And again, they're looking for the one with the fastest payback, but it's not the best. So it's a little bit harder when there's uneven cash flows, as an example. They're just giving you some examples of this because of the unevenness of those cash flows. But see, here's the problem. Here it shows that it's paid back at 4.2 years. Yet you got still some pretty big cash flows on this analysis that you're totally disregarding. And what if it was slow payback, but very large payback later? This could be the overall best investment. You're skipping it. So it's not the best methodology, but it is used, so you should be aware of it. And they're just going to give you some examples here. The accounting rate of return. So you're just taking, again, the average annual investment and then your after-tax net income. That could be depreciation and other aspects. And so that's how they're getting that. Your average annual investment, they're typically looking at a beginning book value and ending book value by 2. This is used, but it's an in-between one. I'm not going to test this one extensively. Again, depreciation can be calculated different ways, which is going to affect it. The income may vary, and the time value of money is ignored. So basically, there's really 2 primary methods, and the first one is the payback because of the simplicity. There are some others that are academically correct or sometimes used, but it's really the discounted cash flow method that is used extensively, and that's what this is. This is called the net present value. This is an important concept, and I would take some extra time to learn it, including it is also on your Appendix B in the book. Let's see, B, starting in B1. I would read that at least once, have an understanding, and definitely the terms on this. This is used extensively in industry, in finance, and it is the most accurate. And what has allowed this to blossom is the use of the spreadsheet and so forth. So what they're taking is the cash flow. Let me see if they give an example here. So they're taking these cash flows over the different years, and then they're multiplying it by some present value to get what is its value in today's terms. So if I have to invest $16,000, but in today's terms I'm getting $20,000 back, then in today's terms this is this net present value. So you choose that investment that's going to give you the highest net present value. Understand, the longer the time, the harder it is to predict this kind of cash flows. And the second aspect of this is, what present value do you use? So again, they're giving you some examples. It's got to be, obviously higher than the 16,000. So let me get to the problem here. And the problem is, why did they pick 12%? This is what is negotiable. And so there are broad economics that tend to say, well, we're using maybe 8% for 10 years or maybe 12%. And basically it comes under, what is the competitive cost of interest rate today? What is the time period? And what's the riskiness of this investment? So using that number, 12% or 10%, is the most subjective component. And this is when I go into deals, is what I argue with why it should be less or more than that. And so, but again, this is used extensively in industry, so do spend some time looking at this. And one of the best reasons for the net present value, or the time value of money concept, is this will work with uneven cash flow. So here you have an even cash flow amount. This is, when it's an even cash flow, the term is it's an annuity. It pays regularly the same amount. Classic example of this would be like a long-term bond. It pays every 6 months. It pays the stated rate or the contractual rate or the coupon rate that you can predict. So this becomes an annuity, which gives you there's a different multiplication table you can use. Understand that this is extensive in formulas and spreadsheets. There's also tables published that people can use. But when you have uneven cash flows, this still works. You just simply multiply the different numbers by still that 10%. Just these numbers will change according to the time. But it's under the 10% column in year 2, year 3, and then you would simply do the variety of years that you're using. And it doesn't have to be even cash flow. And that's one of the strengths of this system. It's very, very exact to some degree. Internal rate of return, a lot of companies do use this. I find it less and less, to be honest with you. And so really you're trying to find the interest rate that matches the cash inflows equals the cash outflows. So you're trying to get, what is the net present value that equals 0? So really, what are you earning in that investment? This is used, I just find it not as much. I don't care about this as much. I am going to test the present value extensively, so do study that one. I'll let you read up on this one. Again, I'm not going to specialize that. This is more of a, companies do want to sometimes compare how different departments or different projects are working internally in their company, so it's sometimes used on that way on a comparative basis. But I'll be honest with you, I find most companies, sophisticated companies, just use the net present value. So this is just a comparison chart, the strengths and the weaknesses and so forth. Again, strengths, like with the payback period, it's easy to understand. Its limitations, ignores time value of money. This is probably worth studying, as you'll probably see some true, false, and some multiple choice questions on that. Decision making. Okay, look, why don't I stop here and I'll go ahead and start another video.